runs one more time back up into the 1 minute fair value gap, which is here. Boom, boom, 3 times. This is the 3 jives pattern, very classic pattern. Then breaks lower. Inefficiency, I like that one. That could be a short. I would be adding to that. My stop would be above here. Well, what happens if you would have got stopped out ICT? Then I would have waited for something like this to occur later over here. Once it broke down and created another fair value gap, I would be shorting there and adding it just the way I just explained it here. So here's what I've just taught you tonight. Obviously, I taught you a greater degree of precision and why I do my entries where you see me entering them on a 1 minute chart or a 5 minute chart. It may not seem logical to you, but I'm looking at these lower 1 minute and less charts. And I'm looking at all the inefficiencies, the order blocks, the point of reference that I'm showing you here. There's just an introduction to it. Every PD array that I've taught, plus the ones that I will never teach you, I'm looking for them. You don't need all that stuff. But I can teach you how to do this, but you have to be willing to listen. You have to go into the charts and look for it. Silver bullets are simply fair value gaps that exist inside of a 60-minute window. There's not a one-trick pony to silver bullet. There's a lot of ways to get into a silver bullet trade. There's more than one silver bullet forming. That's why I said there's always one forming. You might look at the chart. I've seen people already say, I looked at this, it didn't form. This doesn't work. He said it forms every day. You're not looking at these time frames. They're every day, every single day, between 10 o'clock and 11, and between 2 o'clock and 3 o'clock, and between 3 o'clock and 4 o'clock during the London session. Every single day. But you have to know where it's drawing to. We were expecting it to draw above to get the buy side here. It's done that. So once it's done that, what are we expecting? It's probably going to pull back and offer some measure of retracement. That's reasonable. And it gives it. That's all you need. You need movement. Does it offer you 10 handles? If you're trying to get 5 handles, which is what the model teaches, this is how you get it every single day. You'll lose sometimes. I lose sometimes. I get stopped out sometimes. But if I get stopped out and the criteria is still existing in the price charts and nothing really changed, I just had, a run of, poor execution on my stop placement, or maybe my execution entry wasn't as pristine as I'd like it to be, and I get stopped out. If the trade still is viable, I'll re-enter, and you've seen me do that also in my execution videos. So just because I get stopped out or you get stopped out, if the trade still exists in the framework and the logic is still there, look for the next signal to get in on it. You don't need to chase it. Just go on these 1 minute or less time frames and wait for your setup. Think about it like this. If I saw this order block, say for instance I was looking at this area here and I hadn't been in front of the charts until there. I see the order block. Okay, I want to see it reject that. It does. Then we create this little fair value gap right there. When it ran up into it there, and it's the high that I said I want to see the buy side taken on, that right there is an entry for me. I don't need to be in it here. I don't need to be in it over here. I could be in it right there, and that's not chasing price. I could be using this order block right here, because we haven't even taken out this low right here. We have an up close candle. And this is all during 10 seconds. I'm watching all this stuff. This up close candle, when we traded away from it and came back up into it here, as this candle's hitting it, I can be short right there. And my stop will be above the fair value gap candle here, right there. My stop will be right there. That's ultra tight. And I could pyramid more. I could be shorting here, pyramiding more here, because I haven't taken out a structured low that would see acceleration for my trade. And I'm way down here before I get to my target. So in the scheme of things, I'm entering here and my target's here. So this is inception. This is terminus. Midpoint or equilibrium is right here. So I can absolutely take this trade because it's above equilibrium or still in a short-term premium. Ooh, see that? That's institutional order flow, folks. It has nothing to do with volume profile, has nothing to do with level 2 data, DOMs, depth of market, none of that stuff. You don't need any of that stuff. But you do need to know where price is drawing to. Where is it going to next? It's going there for stops, or it's going there because it needs to reprice and re-deliver where inefficiency exists. That's it. That's all it's doing. If it's not going to do either one of those things, guess what it's going to do? It's going to go sideways, and you can't make money in that. There it is. So that's going to be it for this week. Hopefully you've learned something this week, and enjoy your weekend. Be safe, and I'll touch base with you again on Tuesday. Until I talk to you then, be safe.
Well, good morning, folks. Long time no see. How's everybody doing? I'm checking Twitter. I prompted those that follow me on Twitter to give me a 5x5 if the chart and my audio is good and if the volume's good for you. Let me know. As soon as I get a 5x5 from any of you, I'll know I'm good to go. Thank you, folks. Thank you. All right, so I may require I gotta be careful here. It looks like the volume is a little too loud, goes into the red. So I'll have to talk like I normally do. So it should be fine. Anyway, we have a few things that we're going to cover this morning. And if it is your first time here watching a live stream from me, usually when I do a live stream, I'll go in, I'll look at live price action, and depending upon how I deliver, how long I go this morning, I don't think I have a whole lot of time for the teaching part of it and the review. It'll just depend on what we do at the opening, and we'll see if we can look at some live price action. No promises, but we'll see what we see. It's important for you to keep up with the ICT Mentorship 2023 playlist. So anything that I put up, whether it be a live stream like this or another lecture, I add it to the 2023 Mentorship playlist on my YouTube channel. If you're new, okay, and I'll get this out of the way here, some short housekeeping. If you're brand new to my channel and you want to know where to go in and start, my advice is to go into the 2022 ICT Mentorship playlist. It's 41 videos. The first video, you really don't need to watch that one. But for completeness sake, to say you watched it, the first one kind of like sets the tone for what you're trying to or should be expecting. If you have never seen anything from my content, if you really don't know how to read price action, and you really just want to get down to the brass tacks, because I am long-winded, because I want to give you value, and if I'm going to teach something, I want to get the highest form of understanding communicated to those individuals that want to learn. If you're short attention span, or if you are not really interested in knowing everything about why you would be incurring risk or taking on risk, if anything less than that, then you're really setting yourself up for failure. So if a teacher or an educator is making themselves available, it's important that their passion is behind that education, because your results are a direct reflection on my ability to communicate the logic. And I want to convey as much detail as possible, instead of just saying, this is what a buy signal looks like, this is what a sell signal looks like, and then give you a static screenshot of this is what it looks like all the time. It doesn't look like that all the time. There's like subtle little variances in the way price action is delivered. And it's important for you, especially for someone that's new, okay, or if you only refer to price action through a retail perspective. And when I say we don't trade retail or we don't follow retail logic, we're not looking at the things that permeates this industry, which is collective in all the books, courses, and regurgitated. So that's what makes my content sometimes a little overwhelming or overcomplicated, because you're trying to form fit the things that you think you know into what it is I'm teaching. And my challenge has always been, don't believe what I said or say about it. Go into your charts and see if what it is I'm saying is there or not. I'm confident if you do the due diligence to do that, you will find it. Okay, so if you're new and you want to, like a study program, I tweeted this the other day on my Twitter account, but the best, shortest cut, right to the point, pardon me, is the 2022 playlist. That is a model that I designed for my daughter. My heart went into it. I wanted to make it streamlined. I wanted to present something that was time-based. That way it removes a lot of the when does it form? When would I look for a setup? And I don't know what session to trade. I don't know, should I trade London? Should I trade New York? That pattern of looking for that run on liquidity, a shift in market structure, and then going into the fair value gap, that can be traded in Forex. It can be traded in futures contracts, index futures, currency futures. I have students, I don't trade crypto, but I have students that swear by their results being in crypto. I don't trade synthetic things. Okay, so I know I get a lot of questions from the folks in Africa. I don't trade the volatility index. Okay, so I don't do anything crypto. But that model is something that you can go right into the marketplace and start studying and seeing it, and watching other students when they share their examples and or results with me on Twitter. Many times you're seeing that very model form. And that model is, in my opinion, and I may be incorrect in this, but I'm assuming a great deal here, and give me the liberty to do this because I'm going by what I'm seeing in feedback. A lot of the funded companies are coming forward and basically stating that the majority of their profitable payouts are coming from my student base. So that's a testimony in itself. What are they using? What was the thing that bridged that gap between not really knowing what they're doing and going in and finding money, finding profitability, finding consistency? I believe, and the ones I've interviewed and ones that reached out to me, it's the 2022 model. And I have charter members that have paid me to learn one-on-one, not in the sense that they're sitting right next to me, but this is what I did with them every day. I would sit down, I'd go through the charts, and I'd explain to them what they would expect to see in the price action. And I'm in the high 90% of accuracy. And it's been like that for years in the witness of thousands of people. Now there's hundreds of thousands of people that are publicly watching this stuff happen. And that model can be used on intraday charts. It could be used on higher time frame charts. And I've been beat up lately with a lot of requests for coming off of the lower intraday charts. A lot of you don't want to trade or can't trade those 1 and 5 minute charts. I understand that. But I also include, and as I'm including it right here, that same approach to using those shorter time frame charts. The only reason why I'm doing that is because it affords me lots of examples so that we can see there's consistency, and using the logic, you can find continuity in your analysis, and therefore results could be expected to pretty much be, routine or business-like. If you go to your job, you're not changing what you're doing every single day. You're doing the same monotonous tasks all the time. And as a trader, that's what you're trying to do. You want it to be boring and monotonous. And the best way I could communicate it was that 2022 model. I couldn't make another model simpler than that. And it's working. It's working in the hands of other people. And even for people that just started following me last year, they got funded and they're getting payouts and they're doing well. Some of them are trading their actual live money. In my personal opinion, and this is my personal opinion, this is not to discourage any of you, I don't think you should be trading in your first year. There's a lot of things you're going to learn about yourself. And there's a lot of things about price action that you have to learn as well. But that can't be appreciated if you just go and watch a couple videos and then say, well, let me see if it works with my account, and then risk real money or risk, you know, not being successful with a combine or a challenge from a funded, prop firm or whatever. So just go slow. I promise you, the folks that are doing very well, they put a lot of work into this before they did it. And I'm talking about the 6-figure earners. The guy just did $300,000 in 3 months. Another guy, Jade, he's killing $500,000. Okay, folks, this isn't Mickey Mouse money. Okay, that's real money. It's not demo. These guys are killing it. Paladin killing it. I have lots of other people that are getting ready to come forward as well that are just smashing it in their own accounts, not doing prop funded accounts. Take your time. Nothing's going to change, okay? The algorithms are going to change. They're not going to turn it around because ICT has told too many people about it. The markets have always booked like this. And the only thing that's going to change in the future is it's going to be much more efficient. So it'll be less of the choppy consolidation because there'll be a lot more people involved. Therefore, the liquidity increases. So it's not a disadvantage to you or a reason for you to be concerned about more people growing in our community using my content. It's literally going to make more liquidity for efficiency. We're not going to be the buy stop read, then reversal. We capitalize on that retail mindset. My approach to trading and teaching you is that we harvest liquidity. We hunt it. It's prey. Retail logic, things like moving average crossovers and things like that, there's a place for that. It does make money. You can make money flipping a quarter, but predominantly there is a large degree of, neophytes that enter the marketplace. And when I first started, and I promise this is the end, we're getting into the teaching, but it's important for you to know where we're going and where you should be in your expectations and learning. But retail-minded traders think that every single time a overbought, oversold oscillator goes oversold, therefore the market should go up, and that's not true. And I learned that lesson hard in my first year first year and a half. I was insisting upon buying oversold conditions all the time, and I didn't understand bear markets. So it can stay oversold for a long time, and you could be buying falling daggers, and it's very painful trying to catch that. And what I have done in my career is try to communicate things that you wouldn't really learn from anyone else and make it into a language that way it's communicated through charts when the things that make these price moves run are not actually in charts. And that sounds like it's an impossible thing. There are things that are occurring outside of the kill zones I talk about. There are trades that occur, but I could never bridge the gap between what I know about what's going on, therefore finding in a chart that is repeating all the time or enough times to make a setup for it. So the things I teach you, like specific PD arrays, a multiplier, when you're looking for a setup, you're looking for, what is your multiplier? Your multiplier is the thing that you use to get in. That's not a model. Okay, it's the multiplier that puts you in a trade, whether it be my order block, whether it be a fair value gap, inversion, or standard. If it's a institutional order flow entry drill, an optimal trade entry, okay, a propulsion block. All these things are specific multipliers, the things that you're looking for in price action. I teach you, I think it's in month 4 of the core content, and forgive me if I'm not being accurate, but I think it's where it is, month 4, where I go through the PD array matrix. Those are, in my opinion, they're the ones that is the easiest for me to communicate using a time-based chart. Now, I have other PD arrays that are not requiring a chart. Like I don't need a chart, but that's so complicated. And some of you complain about what I've already taught as being complicated. I'm not even going to touch that. Like I don't need to have a chart. I could be driving around in my Corvette, know that at this time between these 3 minutes, I know it's going to do this. And then I know it's going to go this. And I know that. That's algorithmic. But you're here to learn how to do something that repeats over and over again that you can visually see, that you can trust. And that 2022 model, I promise you, if you study that and spend time with it, in between your practice sessions and back testing, that means going back and looking at chart moves that have happened. Um, it builds this experience base that you require to lean on. I have had a lot of requests for longer term swing trades. So I teach in the core content quarterly shifts. That means like every 2 to 3 months, there's a major intermediate term price swing that takes place on the daily and weekly charts. That is like a macro perspective. So when you sit down, like right now, I'm sitting down for the first time, being away from the charts for a few days. I did some day trading on Friday. I might share some of that with you when we get into ES. But I teach in the Twitter spaces that I do, and also in all the things that I'm rambling about usually in these videos or presentations. If you feel like I am not getting to the point is I'm teaching you how you're going to have to navigate these things. And one of the things I talk about in the realm of psychology is if you're under a lot of stress, not feeling well, had a loss in your family or whatever, it's important not to trade. It's important to stay away from the charts because you're going to be hurting. And that pain, that discomfort, that boredom can even spur it on. You're going to do something impulsively. So I've been going through something emotionally with a pet. So I can't focus. So that's why I've spent some time away. She's improving, thank you. But I can't focus when it's like that. And some of you communicate that same type of thing in other facets of your life in Twitter. You're going through a breakup, you've been sick, you just got fired. And then you're wondering why you're not seeing success or consistency in your trading because you're emotionally charged. So even though my concepts, I believe, are superior, you as the operator, me as the operator, I'm the author of this stuff. And if I am sitting in front of the charts and I'm in a state of mind that is unstable, I'm hurting, I'm emotionally charged, I'm sick, or I'm fatigued if I haven't slept in 2 days. It's usually when I need a nap. And sometimes that happens a lot. So whatever those things are, it's going to be for you that as a barrier or a distraction. Or if you feel an overwhelming desire to want to trade because you feel like you need something to make you feel good or get a high off of it, don't consider my concepts as the silver bullet, quote unquote, to fix that for you. Because you can fail even with these high-end, high-precision elements that I'm teaching you. You as the operator will fail yourself. Just like I would have failed myself if I would have pushed last week and did things that I know I wasn't going to be focusing on. It doesn't mean that the logic is flawed. It doesn't mean that your ability to trade is expired. It just means that you are not firing on all cylinders. That means you're not focused. And you're going to be impulsive. You're going to be reactive. Okay. We don't react to price. We anticipate it. But if you go into the charts with a need to be right, a need to feel better, to feel like you are not worthless because maybe someone broke up with you, those things will channel into, and you'll actually see a setup because you want it to be there versus it being there. So just be mindful that when I'm teaching you, that you have a great deal of responsibility. You have that responsibility, and your success is solely yours. But your failures, you have to own them too. I don't co-sign for either one of them. So with all that preamble and monologue out of the way, let's get into it. I mentioned the last few times we were doing market reviews and analysis, I talked about how let me go over my chart and talking to you with the YouTube studio. It's not going to help me. There we are. So this is the dollar index, and it's shown on a weekly chart. So I mentioned that we would likely reach up into, and we wanted to see it get up into the halfway point of this last up close candle prior to this rotation lower. So this up candle over here, the initial draw was that order block's opening price. That's what's being denoted here. We saw it expand up from that. I told you that this gap here, I wanted to see that treated as an inversion gap, okay, or inversion fair value gap. That's what the IFVG stands for. Now, this is the problem that will arise if you're watching someone that is trying to teach my concepts when they're not even fully taught yet. They would see this gap here and it runs up and they'll think, okay, that's a short because look at these relative equal lows down here. No. There's a logic that has to be applied to it and a narrative. The fact that we have unfinished business in this order block, there is uncertainty. There's a lot of, there was concern about the U.S. debt ceiling, a potential default, the WAR scenario on the other side of the world. Okay, all these things are causing concern, and that concern is a catalyst for flight to quality or a safe haven. And at the time, at the present, the dollar is still considered that, but I think it's waning. Nonetheless, that sends typically the dollar higher and foreign currencies lower. And we're going to talk about Forex tonight too, or today, and not just ES. But I started with the dollar index because the dollar gives me that risk on, risk off scenario. Now, if I believe that the dollar is likely to go higher, I need to know where it's going to likely draw to. I just can't just indiscriminately go out there and think, well, it's going to go up. Let's just see where it goes. Let's just find out. Okay, that to me is myopic. You need to have a specific level, not a zone. Okay, and not a supply or demand zone. There's specific levels that I'm teaching. This last up close candle right here has the low, the opening price, and the mean threshold, which is the halfway point from high to low. That's what those levels are. The last time we talked, I said we would like to see it get up into, and I said we'll see if it wants to get up to the mean threshold of that order block right there. Nothing said we're going short on dollar. I didn't say we're shorting anything in dollar. We were looking for lower prices on euro dollar, and we'll cover euro dollar when we get at the dollar. So in fact, we saw price run up into it last week, and now here we are on the present week. This is this present current weekly candlestick for the dollar index. Did this gap over here act as support? Yes. Intra week, it did it on this week, but then last week it did it as well. Traded down into it, and now we're trading here. So when we get a lower time frame daily chart, this will be more impactful too. But whenever I give analysis out, whether it be through a tweet or in video, invariably there's this sect of my followers that will say, okay, now what's going to happen? When you should be thinking about what you just watched, and have you broke it down yourself? Have you spent any time in the lower time frames, individual sessions, individual days over the scope of each individual weekly candle and see where the setups form with the 2022 model? Because that's what you're supposed to be doing. If you're just waiting for me to put up a new video or talk about something on Twitter, you're really doing yourself a disservice, because a lot of the work, 90% of the work for you succeeding, is done by you. It isn't just by listening to me. Because if it was that easy, everybody that watches my videos would be funded, making money, quitting their jobs, and be rich, and where's all the yachts, right? They don't do the work. And that's why it's offensive sometimes when I tell people, you're not putting in the work. Because what you think the work is many times insignificant. It's not enough. And you have to put real time into it. And what you're doing in that time is spending it in old moves, using the logic and the experience I've shared. I told you that I was wanting the dollar to go higher. That was, go back and listen to the commentaries. It's there. It's not ambiguous. But because I state my opinion, there's a lot more of you publicly that are following me. You sometimes are waited on bated breath just to hear me say something, and you take that and you go out there and you bet real money with it. And that's why I said, don't bet the farm on it. I'm constantly reminding you there's risk. If you don't know what you're doing, don't be deceived in thinking you think you know what you're doing simply because you watched a few of my videos. It takes time to learn this, and you have to give yourself the time and patience that's needed to do it. So we did in fact see the inversion fair value gap form here, and we're rotated up into daily bearish order block. This right here will be much more easier to see and understand now when we go into a daily chart. Okay, so here's that daily candle. So it looks just like that weekly candle. We have this big old run up here like that. It does not, folks, listen, okay? It does not need to be an engulfing candle. That does not make an order block. Okay, there's so many people out there typing that stuff up in pseudo mentorships things, and like that's not my order block. Okay, the idea of the market rotating after hitting a key level, you take it right to the last candle. That candle does not need to be engulfing anything. That narrative, that's the thing that's missing from these 20-year-olds that run around thinking they know how to do this stuff. And I'm talking to you because I know you're listening. Okay, I'm telling you these things so that way you can improve and not hurt the people that you're trying to fleece. I'm being more responsible with your students than you are. So here's the bearish order block, the opening price. Now, why am I using the opening price versus the low? Whenever there is a short little stubby tail or wick, okay, whenever it's like that, I generally, as a rule of thumb, but not always, but generally, most of the time, I'm going to go right to the opening price. And the reason why I'm doing that, okay, and this is where you write things down, folks. This small little tail on the candle, I know that there's probably something in that lower time frame that I'll be able to use, even if it wants to go outside the realm of the opening price. So I may be able to look at something that may or may not be supportive for a trade in that range. But for a anchoring on a higher time frame basis, I'm anchoring it to the opening price. Now let's assume for a moment that it was a longer tail. In other words, this little segment down here on the candle, say that was longer and the opening was actually somewhere up here. Then I would use the low. And I would use the consequent encroachment of that tail or halfway point of that little wick. So those are the two key levels I would use for a candlestick that has a longer wick. Okay, so there's a little bit more insight about order blocks. And I'm telling you why I'm using the opening price versus the lower high. So have that in your notes and go through your studies, and you'll see that that's is a short little stubby tail or wick. Okay, whenever it's like that, I generally, as a rule of thumb, but not always, but generally, most of the time, I'm going to go right to the opening price. And the reason why I'm doing that, okay, and this is where you write things down, folks. This small little tail on the candle, I know that there's probably something in that lower time frame that I'll be able to use, even if it wants to go outside the realm of the opening price. So I may be able to look at something that may or may not be supportive for a trade in that range. But for a anchoring on a higher time frame basis, I'm anchoring it to the opening price. Now let's assume for a moment that it was a longer tail. In other words, this little segment down here on the candle, say that was longer and the opening was actually somewhere up here. Then I would use the low. And I would use the consequent encroachment of that tail or halfway point of that little wick. So those are the two key levels I would use for a candlestick that has a longer wick. Okay, so there's a little bit more insight about order blocks. And I'm telling you why I'm using the opening price versus the lower high. So have that in your notes and go through your studies, and you'll see that that's a very good general rule to help you. Okay, there will be instances where it does other things. Okay, but I'm not done teaching. But just grow in what I'm sharing now. I'm giving it to you. So we have the weekly order block. We traded up and through it. hit the daily bearish order block. We traded up into that. Now look at the bodies of these candles. Weekly order block, daily order block. Look at all that encapsulation and price action. The volume of all that trading, the majority of it's being shown in the candlestick bodies. Yes, it expanded, as we would like to see anyway. We're expecting it to go higher. It went above these levels. We don't expect it to stop dead in its tracks when we're bullish. We really want to see it go to it and through it, because the narrative, the expectation we had, was the dollar should go higher. And notice that all of the sustained price runs was on the buy side delivery. That means candlesticks that are going up. Infrequent were the down close candles. These are daily candlesticks, by the way. But look how it opened here, traded away from it. Opened, rallied up here, and then traded down. We expanded through and fell short of the main threshold of the weekly order block. And it's important that you annotate your levels. Now I'm showing you how I do this here, and some of you ask all the time, how am I doing that? On TradingView, this is what I have it set up as: middle, center, for it to appear here. And when I'm doing the new week opening gaps, it would just show on the right. So it shows over here. And you'll see the new week opening gap when we get into ES. So we're seeing it dig into these levels, expanding up, reaching, and then finally, once it pierced the mean threshold of the weekly order block at 104.540, then we had a rotation lower. Where did it go back to? That weekly inversion gap, the fair value gap that we anticipated seeing it act as what? Support. Folks, that's narrative. That's not picking both sides of the marketplace. If I'm telling you a specific PD array, that level on that PD array, if it's a range like a fair value gap, it's the high, consequent encroachment, which is the midpoint, and then the low of it. That's not a zone where it's ambiguous. Like, where do you trade a supply and demand zone? Okay, that's why I'm not supply and demand. And I also cut through candles. Supply and demand would not use this level over here based on anything like that, because they say we don't cut through candles. They need a fresh zone. Everything from ICT is fresh, baby. Everything. There's nothing stale here. We always have fresh bread, and my students are always making fresh bread. They do it on their own. They don't ever run out of yeast. Just like this mentor talking to you, I don't ever run out of yeast. You're never going to run out of opportunities. It's never going to happen. There's no reason for you to rush it, because once you get it, nobody can take it from you. Nobody can say you can't do it because they don't like you. They don't like your personality, whatever. You can find these setups. Once you have the understanding, you can go into any market, any time frame, and murder it. Literally murder it. But you're trying to be too quick to assume that everything that you already know will complement what I'm teaching you. No. No. What I'm teaching you will make the stuff you tried to be profitable with profitable. If you include the things I'm teaching, how to read price, the draw and liquidity, that's the first lesson. The first lesson I start to drive home in a student's mind is, where's the price trying to gravitate to? Where's it trying to get to? Well, initially I started with the order block, the weekly, then the daily, and the mean threshold of that weekly order block. Does your chart show this? Because you're looking at a live chart right now with me in the live stream. Did it pan out like I showed? Absolutely it did. The same direction I was looking for. Everything I was looking for in terms of the specific levels, I gave you the logic. I talked about it beforehand. It's here now. So it wasn't done with a 1 minute chart. It wasn't traded or worked with in a second chart, sub 1 minute time frame. It wasn't even on an hourly chart. I used weekly charts. It works, folks. You can make this work for you. Where you are at in your life, school, business, job, your relationship causes constraints that you can't do the intraday charts. I get it. But don't think that it's a one-trick pony that only works on a 1 minute chart. There's a lot of 1 minute setups that allow me to teach you that there's no short supply of setups. You will always find setups. But there's going to be times when the market will be, well, look at all this mess in here. I don't like these types of periods. I don't like that. And that's why you see me do what? I took time away. I did road trips. Now looking at the price action in hindsight, now it makes perfect sense to you why I was doing what I was doing, right? But at the time, you're thinking, oh, they changed the algorithm. ICT's on the run. No, I'm relaxing because I know that all I need to do is see a shift in market structure. What was that? See this high? It breaks it. What does it leave? Fair value gap. See that? Now, we're going to talk about gaps today. My personal private students and the public students, all of you, probably majority of you here, are constantly asking this question. Can you talk about the breakaway gaps? Can you talk about when fair value gaps should not fill? I'm going to teach you about that today. Okay. So if we're looking for a draw on liquidity and we are in this vicinity right here, the first thing we want to draw our attention to was this imbalance here, that shaded area. Now, when I'm showing it to you on a daily chart, and that's the time frame this is being shown in right now for the dollar index, I promise you all of this works in ES. It works in Forex, because I'm starting this whole presentation. This is going to be Forex in the beginning, and then I'll end the discussion in today's live stream on the index futures. But everything I'm teaching you here is applicable to Forex and futures and commodities and gold and bonds. We're going to talk about bonds today too. Okay. But all of this higher time frame gives you, in my opinion, you're welcome to disagree. You're never going to convince me otherwise, but the higher time frames is where the majority of your time should be spent, because it's so easy to get lost on these lower time frame charts, especially if you're new, because you'll think you see all kinds of stuff. The Three Stooges pattern, there isn't one, but I'm just making a joke about how everything can be applied to any time frame. If you want it to be there, you'll see it. It's like a mirage. You're thirsty. You want to get that new drink of success. And just like sometimes in a desert, you'll think you see something out there. It looks like water, and you get up on it, it's just more sand. And you don't want to fill your well with sand by chasing setups that are not there. They're phantoms. Higher time frame removes most of that. Not all of it, removes most of it. So now let's talk about, and again, before I get into any discussion, I want to take you back to the weekly chart and show you what this is again, this shaded area right here, real quickly. I like to be complete, folks. I don't like to leave anything up for debate. That little section between this candle here, that low, and this candle's high. And the reason why I'm drawing attention to that is, let me take this away just for a second. Can you see how this candle dropped, stopped? The next candle here opened, traded down all the way here, and came back and stopped. The next week it opened, traded up a little bit, but didn't come back all the way to that candle's low. See that? So there's a distinct gap, separation between those two key levels there. And then we expand lower, and we open, trade up, leaving this little portion of price action between this candle's low and this candle's high remained open. Okay, so it's only dropped down. So that's sell side delivery. What is it? Inefficient. Buy side. So it's a SIBI. Sell side inefficiency, buy side. Oh, I said that wrong. Sell side imbalance, buy side inefficiency, SIBI. That little distinct gap there stands out. If we were standing over here on the right of all this price action, look how fortified all these back and forth movements are here. All these candles moving back between over and over again inside of this range here. You see how that is back and forth, back and forth, back and forth, back and forth. That is not inefficient at all. That's a lot of back and forth delivery. In other words, think of the analogy I many times use, like a paint being applied with a roller on a wall. In this area, paint has been distributed back and forth, and paint in this analogy would be price. So the range of offering liquidity up and down in that shaded area, there's no inefficiency whatsoever on this time frame. So where does the inefficiency exist? Right there. It only has one roll down, never up until we get over to here. Okay, so that fair value gap there was the draw up, and the context was I want to see it trade up through it and come down and act as support, and that would make it an inversion fair value gap. If I didn't hold that expectation, it would be treated as a standard fair value gap in a premium relative to the high and the low here. That would be a premium fair value gap. And the way you know that is you take the fib, anchored on a high, down to the low. Here's equilibrium, and the fair value gap exists right there. At equilibrium or above is premium. At equilibrium or below is discount. But I did not say we're looking for lower prices when it got to this fair value gap. I said we want to see it go to it, through it, and come back down and treat it as support. That's an inversion fair value gap. Don't take my word for it here. Go back and look at the other reviews that I've showed here. Go and look at the tweets. Listen to the Twitter spaces. Sometimes I cuss there. Just be mindful that, it's live. Here, I tend to do a better job because I'm looking at candlesticks, but if I don't have a candlestick chart in front of me on Twitter spaces, I generally use blue collar language, and my imbalances inside me just make me not the best mentor for that. But that little gap here is this segment. When we go down to the lower time frame daily chart, now you know what you're looking at. Right there. See, it doesn't look like a gap here because look what it's done. It passes back and forth, okay? Do not assume, this is really important, do not assume that a inefficiency, whether it be a fair value gap that's a buy side unbalanced sell side inefficiency or a sell side unbalanced buy side inefficiency, either or. Don't assume if it's on the daily chart that if you see on, or a weekly chart rather, don't think that we see these back and forth moves on the daily chart that now makes this a balanced price range. It doesn't. Because on the weekly time frame, it's inefficient still. The higher time frames have to have bodies hit the floor. That means it's got to cover that gap. Even though these individual daily candles have worked inside that range, that's not. You're seeing the formation of that weekly fair value gap with all of this in here on the daily chart. It's something you have to study on your own, working a higher time frame down to lower time frame. The higher time frames are parent. The lower time frames are subordinate. They're only going to behave in a manner that allows certain price delivery within the context and constructs of a higher time frame imbalance or liquidity pool. That's it. That's the liquidity continuum. What you're looking for. The market has to go up to a premium for what? Only two reasons. It's going up to take the buy stops, or it's going up to some inefficiency, some gap. Markets only go down to go to an inefficiency, a fair value gap below current market price, or it's going down for sell stops. I do not care. This is no disrespect to anybody else out there that teaches and made money. I don't give a flip. The markets don't go up and down because your indicator said so. The market doesn't go up and down because there's momentum of buying and selling pressure. That is not what is going on here. Okay, it's never been that way, but we have been led down the primrose lane with books, authors, teachers, whatever, saying that it's buying and selling pressure. It's not. These markets are absolutely controlled. Period. If we can see the likelihood of price action wanting to at least get up to this level here, why did I use that fair value gap? Remember, I'm painting why I said this was something important. Why did I pick that weekly fair value gap? And why did I want to see it trade through it and become support? Because it's at a level that on a simple run of the daily chart, using this dealing range, this low to that high, remember I'll add the fib back to it. Folks, this is real learning. This is the point. Okay, the point is you want to know what you're doing. If you want to go out there and gamble your money, go watch somebody else. Okay, you're welcome to do that. But if you want to learn and you want to learn correctly, you're at the right place. That fib at 50 is halfway or equilibrium relative to this high and this low. So if I'm waiting to see price to try to gravitate to here, I want to see, does it perform what I would really rather see happen? I don't want to see it go up there and then sharply break lower, because if it does that, then I got to drop down to a lower time frame and look for a fair value gap or something else on a short-term premium to sell short, because it would likely run into these relative equal lows. But my experience in 30 years told me, that all the factors that's going on right now in the world, geopolitically, all the turmoil, all the things that's going on, the economy, all that stuff is a cause for uncertainty. And because of that, I want to see, yes, my PD array is going to be a draw on liquidity. It's going to draw up to that weekly fair value gap. But I already announced to you that I'm going to see this do something other than just go up into it and treat it as an area to sell short from. I want to see it go through it. Does it do so? Yeah. Look where it closed. Above it. I did this stuff real time in live streams where I taught you how to discard or disqualify a fair value gap. So that way, it looks like cherry picking because I'm showing you examples, and a lot of people that hate me or trolls and people can't keep up with me, they'll insist that it's cherry picked, but they don't know the logic. And if they would just simply listen to me now, I'm telling you what I'm doing. So that way you can go back and look at the things I've shared and say, oh, yeah, there it is. Right. I'm not pulling things out of thin air. I'm pulling it from 30 years of experience. I authored these things. So I'm sharing that language so that way you can learn how to do it. So this fair value gap was the initial draw on liquidity. When we shifted above this high here, that candle right there that runs above that short-term high, that's a shift in market structure. Now market is in a buy program. A buy program is now when you start looking for premium arrays. Where do you look for those premium arrays? Well, what is the dealing range? That is this high to that low. We're only interested in premium. So we don't look at this short-term high as a turtle soup, run above and go lower. We don't look at this high here as a run above that and turtle soup and go short lower. No, we're looking for the first equilibrium or higher PD array. We started on the higher time frame. You want to do a top-down analysis because large institutions, big funds are going to be using higher time frame charts. So we're going to cannibalize their long-term models. Their long-term model through here was bearish. So we're looking inside the scope of this high to that low right there. Midpoint is here. That shaded area in orange, I'm assuming it's a hue of orange, but that shaded area, that's the weekly inversion fair value gap, that's the first level of my interest. Okay? So this specific weekly point of interest, I gave you the context as to what I want to see with it. It wants to go higher, great. I need to see something specific. I want to see it trade to it and through it. We've seen it close right there. If a market closes above a fair value gap that you think should be bearish, that's not a good shorting opportunity. Many times it's communicating to you that it will become an inversion fair value gap. Oh, there you go. The penny just dropped. I just gave you something again. But if you're not listening, okay, if you're not trying to context as to what I want to see with it, it wants to go higher, great. I need to see something specific. I want to see it trade to it and through it. We've seen it close right there. If a market closes above a fair value gap that you think should be bearish, that's not a good shorting opportunity. Many times it's communicating to you that it will become an inversion fair value gap. Oh, there you go. The penny just dropped. I just gave you something again. But if you're not listening, okay, if you're not trying to filter out the buy and sell signals, then you think I'm teaching you in Morse code. I'm teaching you specifics in detail. I'm teaching you in Morse code. I'm teaching you specifics in detail. This is the point. You want to be trading with precision. You want to be able to read the charts without me and nobody else helping you and be independently wealthy. All these things have to have a lot of understanding and logic. So that way you can trust it. It's not changing and morphing all the time. The rules aren't changing. The goalpost is not being moved. You know that these logic gave you something. If a market closes above a fair value gap that you think should be bearish, that's not a good shorting opportunity. Many times it's communicating to you that it will become an inversion fair value gap. Oh, there you go. The penny just dropped. I just gave you something again. But if you're not listening, okay, if you're not trying to filter out the buy and sell signals, then you think I'm teaching you in Morse code. I'm teaching you specifics in detail. This is the point. You want to be trading with precision. You want to be able to read the charts without me and nobody else helping you and be independently wealthy. All these things have to have a lot of understanding and logic. So that way you can trust it. It's not changing and morphing all the time. The rules aren't changing. The goalpost is not being moved. You know that this logic is sound. You've seen it many times before and you can trust it. So that way when you go forward and you're in forward testing and then before a compounding challenge or if you're trading with your own account, you'll trust it. You won't be nervous. It's the same type of thing like when you go to work. You know the different routes that you can take to get to work. Is the map changing? Sometimes there's a detour that's required. There's construction. Well, guess what? Sometimes the market will do a little hiccup and you didn't see a specific time frame do something and it might stop you out. Okay, recalibrate like a GPS. What does it do? It reroutes you. As long as this objective of the weekly order block, which was the draw on liquidity, this was the multiplier, the inversion fair value gap. So I wanted to see, does it get to it and through it? Yes. Does it treat it as support in the lower time frames? It does. And then trades up to that weekly order block, daily order block. And the last level you heard about was we want to see if it wants to get up to that 104.54, which is the weekly bearish order block mean threshold. Now, that's a lot of stuff. There's no way I could say that in less time and teach you what I just talked about. What was going through my mind? Why did I talk about that level right there? That is the shortest, absolute shortest way around getting between point A and point B to the point. That was the logic that I used. Think about how you could have said it with less words and make it make sense. You can't. So stop, okay? Stop expecting something to be condensed when this is condensed. But it's specific so that way you understand the logic behind it. So now let's go into grading a price swing. So we have these levels here. The first one I drew your attention to was that weekly order block. Now, I could have very easily laid all these out here in advance and said, watch all three of these get hit. But you're learning. your understanding is a graduated experience. And charter members could go right into this and see it right away. People that have been with me for a very, very long time. If you're new or relatively new, if I lay this level here, and what I'm about to say is not to be construed as talking down to individuals, okay? I'm just reminding you where you're making the mistakes. You are. I'm not making the mistakes. I'm telling you to be careful. But if I say, I like this level here, and you foolishly go out there and you try to trade with your money or risk your funded account on it or try to do a combine challenge and insist because ICT said it's going to go up here, between this point here and this point down here, there's lots of room for error. If you don't have a lot of experience or don't know what you're doing, or you're impulsive and you chase price, even if you do use a stop loss, you'll get caught up in these retracements that you won't expect or anticipate. And you'll walk away thinking this stuff doesn't work. And then now here we are, it goes right to the levels that I've talked about. So between these two price points, with this shift in market structure here, and running up into that weekly bearish order block mean threshold. Again, this level here, right there, let me take the fib off because there's more lines on there that I want to show you. That level here is not anything in this fractal of any importance. It's the weekly chart. It's this one here. The mean threshold. This is the halfway point of this candle, and that's done by like this. You take the fib, drop it on the low to the high, bam, right there, 104.540. That's why that level's there. It's half of that. Now let's drop back down into the daily. So we had a market structure shift here, and right away we have this fair value gap. Now watch, folks. This is not quarters theory, okay? Because you're going to hear somebody come out and say, oh, he's teaching quarter theory. I was doing this stuff before quarters theories was even talked about. This is what grading a price swing allows you. You have to know what? Where's the draw on liquidity? Where is the terminus? The end of the line. Where do you think price is going to go? It doesn't mean that's where it stops ultimately and reverses. Where do you see your setup form? Where's the framework? Where is the dealing range that you're going to work within? That dealing range is always in the past, high to low. We framed the equilibrium price point here, and we're aiming for a premium. Why do we want to see that? Because we want to see it trade into this fair value gap and above it, which would nullify, it would remove any need to anticipate lower prices on dollar. It's signaling to you algorithmically that it is not going to go lower. It in fact wants to go higher. So if we can do that, and we see it does, it closes here, that really increases the opportunity for this fair value gap to be inversion fair value gap. That means it's going to act as a resistance broken turn support, to use retail-minded logic. But this would never be construed as that because it doesn't fit any of the type of thing that you would expect with retail support and resistance, nor does it meet the criteria for supply and demand. Before you go out there and you wreck yourself in your live trading or whatever, it's important to know these types of rules, because if you are slow in making money and fast in trying to preserve or keep it, those two modes of thought or conducting a daily routine move very, very slow when you're trying to make money, because there's lots of opportunities to do that. Every single day there is. Every single week, every single day, every single session, there's something that you can capitalize on. Every single day. And in fact, specific hours of the day, you can trade 1 hour candles and treat it just like this whole idea that I've shown here on the basis of that weekly candlestick. All this stuff is applicable inside of a 60-minute candle. It all exists there. It's a tiny little universe within that one time frame. You can break these things down smaller and smaller and smaller. but you don't have the experience yet, and you have to give yourself the time to acquire that experience. And once you have it, then it gives you confidence. And you got to be very, very careful. Once you get that confidence that you know what you're doing, it doesn't evolve into egomaniac, attention whore. Okay, I was always that when I was in 20. When in my 20s, I this kind of stuff made me feel superior to everybody, and I communicated that always. And I don't, even though my stuff is superior, I don't view myself in a manner where I have to go out there and stay and prove it. I don't have to do that anymore. I have students now that are doing it. This price range, okay, that I'm looking forward to if we get this shift in market structure. I'm sorry, shift in market experience yet, and you have to give yourself the time to acquire that experience. And once you have it, then it gives you confidence. And you got to be very, very careful. Once you get that confidence that you know what you're doing, it doesn't evolve into egomaniac, attention whore. Okay, I was always that when I was in 20. When in my 20s, I this kind of stuff made me feel superior to everybody, and I communicated that always. And I don't, even though my stuff is superior, I don't view myself in a manner where I have to go out there and stay and prove it. I don't have to do that anymore. I have students now that are doing it. This price range, okay, that I'm looking forward to if we get this shift in market structure. I'm sorry, shift in market structure here on this candle here. At that moment, we have entered a buy program. So we have to go back into this range and anchor it to where we anticipate price going, that draw on liquidity. The initial one was here. This one, I don't believe I mentioned it, but I'm going to say I didn't. But you can see clearly it's anchored on the daily chart. But I did tell you this one here. This is where we want to see if it wants to get up into that. So all of this run here, we could be sitting still, anticipating, not reacting, anticipating a run above that short-term high here. Why am I talking about this high? Man, he finally talked about it. He's finally saying it. I've been screaming at this monitor, Michael, why are you wanting this high? Why didn't you use this high? Why didn't you use that high? Why not that high? Low, lower low, lower low. Okay? We consolidate. All through April and May, I'm outie. See ya. I want the market to show me something. So when I was down in Florida, when I was cruising around in my RV, and I don't live in an RV, goober, I want to see it move out of this range. Okay? Let's, just for a moment, let's ring in the bond market. Okay? If you are on Twitter, I believe it was Twitter. If it wasn't Twitter, either I did a video, short little video commentary on Twitter, or it was mentioned somewhere in my commentary on the YouTube channel, but I know I talked about it. And you'll see the chart right away and remember it, those have watched it. But during this consolidation in here, I want to see it perform a specific way. I want to see it show me something. All through here, I wanted to see the dollar go lower. I expected it to take out that low. But because it was showing an unwillingness to perform or show any willingness to go lower, how did I get to the point where I didn't trust it? Talk about how when we don't want to take a trade, when there's something in the price action that says don't do anything. Okay, let's do that right now. Here we have this low right there. See that little pierce below it right there? Little tiny little short move below that low right there. It can and it could have very easily